Hey everybody, I'm your accounting mentor and welcome to Adjusting Entries. This topic can be difficult to understand, so let's break it down. First, you must understand accrual basis accounting since it is used to conduct adjusting entries. Accrual basis accounting records when revenues are earned and expenses are incurred. Specifically, these entries are recorded in between cash transactions. There are 4 versions of adjusting entries and I've provided an example for each. Deferred revenue. Revenue that is unearned. In this example, the asset of cash is received and recorded as a liability. Unearned revenue is a liability representing a future obligation by a business. After, say, a quarter of a project is complete, an adjusted entry shows that a quarter of unearned revenue has now been earned. Unearned revenue is deducted, while the revenue account shows revenue is increased to show earnings. Accrued revenue. Revenue that is earned. This time, the service is performed first and the client is billed after, as seen in this adjusting entry. Revenue has already been earned, with the asset account and accounts receivable representing what has been owed by a customer. 1 month later, accounts receivable is converted to cash by the second entry, showing payment by the client. Deferred expense. Expense that is prepaid. In this scenario, rent of a delivery truck is paid before it's used, creating the asset account prepaid rent in the first entry. After 1 month, an adjusting entry is prepared, where an expense over the month is recorded along with the amount of prepaid rent used or expired. Depreciation is a unique example of deferred expense. Over time, depreciation will lower the value of an asset. In this case, it is Blake's equipment on a monthly basis. The entry shows the expense due to depreciation, as well as crediting the contra asset account accumulated depreciation. Note, the asset's value is not reduced. Accumulated depreciation is always the account credited when recording depreciation. Accrued expense. Expense that is incurred. In the case of salary, an expense is incurred halfway through the month on the 15th of April, but only paid at the end of the month. Half of monthly salary is recorded as an expense, as well as a liability being salaries payable. Now here's an example of what happens when an event is recorded incorrectly. Once again, Blake the builder receives $400,000 as a deferred revenue. However, she records so as revenue rather than the liability unearned revenue. An adjusting entry must correct the accounts later to show $400,000 was originally unearned revenue. $300,000 must be deducted from source revenue to leave the actual amount earned. $300,000 must be added to unearned revenue to mark what is yet to be earned. It is these correcting entries that can make this topic difficult. Now here are 5 tips to get through adjusting entries. Tip number 1, adjusting entries are recorded at the end of an accounting period. Tip number 2, your cash is never involved in an adjusting entry. Tip number 3, learn which accounts are relevant from key terms. Tip number 4, observe the specified measurement of time for the adjusting entry. Tip number 5, note what the adjusting entry needs to correct accounts from previous errors. Thank you for watching, and good luck with adjusting entries.